and welcome to a brand new episode of Smart Money. On Smart Money this week, we speak about how you can plan and protect your family's needs, your family's expenses through the insurance route. Now, what is the right insurance policy for you? Do you need insurance over and above the corporate insurance that you are provided with? And what are the different options that you can look at through the course of your investment journey? We have Nasser Salim of FlexiCapital on the show, and joining us here in the studio also is Nehal Mota of Finnovate. Nehal has over 15 years of experience in the industry. She's worked with ICICI Securities and IIFL in the past, so she joins us here on the show. And Nasser, of course, has been with us on the show many times in the past. He's a, he's a financial planner. He's an expert in the market. So, lady and gentlemen, thank you so much for joining us. Nasser, I want to start with you. The reason why this is more important is because post-COVID, people have, begun to sit up and take notice, evaluate their insurance schemes and plans. So let's just put it out there before we talk in further detail about what are the different insurance plans that are available in the market currently.
Good afternoon, Sonia, and thank you very much for having me back on your show. Very interesting topic and great question. I think, post-COVID, what has happened is people have kind of well-weathered this entire anxiety time that they've had. So, for 3 years, practically, we were wondering what will happen. And therefore, a lot of questions and, clients started showing interest and trying to understand what are the essential plans that one needs to cover. And broadly, Sonia, I'll tell you, I think the insurance here that we're going to discuss today is purely mitigating those risks that can happen unwarranted, undesired, all of a sudden as an accident. And therefore, the most important ones to cover broadly are the ones such as pure term plans, which we will talk about the advantages of pure term plans. Then there is something called endowment plans, which are a mix of both pure term and savings, which will give you protection and savings. Then there is, we will talk specifically about employer-employee plans. Then there is unit-linked insurance plans. We will talk about traditional plans, and then there are, a mix of all of these coupled with what we call as endowment plus plans. So broadly, these are those plans that we will talk about.
Okay, so we'll get talking about them one by one. Nehal, I believe that a term plan is one of the most important things that you need to have in your financial journey. But I understand that a lot of people still don't have it despite having, dependents like a husband, children, wife, parents, etc. Tell us, what are the key features and advantages of having a term plan?
Thank you, Sonia, for inviting me on the show. And like you rightly said, the mortality protection in India, for every 100 rupees of risk which an Indian family takes, on an average, they have 9 rupees only as cover. So the gap is 91%. Okay, that's the kind of less mortality protection which we have. Having said that, like Nasser said, the pure vanilla term insurance is something which all need to have. And typically, if you are age 30, then you have, say, 30 years more of your working life left. So 20 to 30 times of your annual income is the kind of term policy which you should have. If you're in 40s, then maybe 15 to 20 times of your annual income as a term cover. Okay, so I'll say that the term cover is needed for replacing income. If something were to happen to me, I have a dependent son, I have dependent parents, okay, my income which I generate and give to the family for the next 20 years needs to be replaced by the insurance policy. And that is why a pure term insurance is a must for every family. Okay, and every earning member of the family.
Okay, I got that. I have two questions here, follow up. One is, if you have adequate assets in the form of financial assets, right? If you have SIPs and you have a certain amount of corpus that you have perhaps left behind for your children, your husband, etc., do you still need a term plan? And B, what is the right age to take up a term plan?
Okay, so Sonia, you have built assets. But like I said, there are two components to a term policy. One is that at the age of 40, I have some assets, which is already the wealth which I have created for my family. But for the next 20 years, I'm still earning and I will still add to that wealth. Okay, so I need to replace that income which I will generate for my family, which will add to their wealth through a pure term insurance. So that is one way, which is income replacement. The other way, like you rightly said, is that I look at, what is the income which I need to, replace. I, actually subtract the assets which I've already created, I add the liabilities, and then I get a logical amount of cover which I want. So to each one, its own. A lot of clients come that we really want to ring fence or protect the income which we will generate. So it could be a pure income replacement. It could be income replacement, adding the liability, subtracting your assets, and the right age. The early you take the term policy, the better it is, because when you are young, the premium is very less, and you are locked in that premium for a very long term.
Okay. Nasser, I have a couple of questions here. First, of course, the advantages of having a pure term plan, and also what are the do's and don'ts, right? While picking a term plan, how do you select which is the brand that you pick? What are the red flags that you need to sort of look at before selecting a good term plan?
Sure. That's again a great question. So, one of the first few things we need to look at is just not go by the brand by itself, Sonia. I think when you're looking at a term plan, there's something called the claim settlement ratio, which is popular in CSR. And I think a score of over 95% for consecutive years is generally a good trend and a reliable trend to kind of follow. Now, where do we get this claim settlement ratio, and what is it basically? A claim settlement ratio, Sonia, is nothing but the percentage of claims that the company has settled in a financial year compared to the number of claims placed with them. And you can get this from the Insurance Regulatory Investment Authority, IRDA website, which basically has under its CSR claim settlement ratio corner, where you can get for each of these insurance providers. Number one. I think the other very, very important point is you can get this feedback from a lot of online platforms to say, what is the level of service? You see, when you are hit by an exigency, what is the kind of level of service and the turnaround time to kind of ensure that the settlements are made reasonable within timelines. So I think that's also very, very important. Two very important parameters is this. And I think one, of course, not the last is when you're looking at a term plan, you can look at some of the larger private sector players. And when I say that, it will obviously be a function of, again, a high claim settlement rate. Okay. So these three things, I think one needs to kind of look at.
So have a higher claim settlement ratio and pick some of the larger, you don't have to go for a brand necessarily, but the larger players in this business. Anything else?
Yeah, I'll add to this that what Nasser rightly said, that in terms of the percentage of claims settled versus, the claims they got, you should always also keep on the eye on the value of claims settled. Okay. Because it can happen that you're settling a lot of smaller claims. Yeah. So you are actually getting a higher percentage, but you are actually avoiding high value claims. Okay. So together with the percentage of claim, it's also good at looking at the value of, the claims which are settled in that financial year. And like he rightly said, it's easily available on the IRDA website.
So the claim settlement ratio generally has to be over 95%. That's the best. That's
95. The best. And most of the top private life insurance companies, private, public, both, are at 95, 97, 98.
Okay, so look at the amount of claims they settle, the claim settlement ratio, and the value of claims that they're settling, right? Yes. The higher claims that they settle in terms of value, it's better for you. All right, let's move on to the Married Women Property Act. Now, this is a subject, of course, that you have spoken about in great detail in the past. So who is it for, and what are the key features according to you, Nehal?
So, PPF is one instrument which is a deemed trust. By the virtue of making an investment in PPF, it's a deemed trust. Second deemed trust which India has is the Married Women's Property Act. So in this, a married man, if he takes a policy on his name and he makes his wife as a trustee and wife and children as trustee and beneficiaries, the insurance, a life insurance policy, all the maturity proceeds from the policy are ring-fenced under a deemed trust, and they can only go to the beneficiaries in the trust. He could choose his wife as a beneficiary, wife or children as a beneficiary in whatever ratio. Once this deemed trust is formed, it's irrevocable. So even if the married man in future wants to change the trust, he cannot change the trust. So it's a very good tool for you to, put in certain amount of your wealth in a deemed trust, just like PPF.
Okay. Nasser, you want to comment on that, the benefits and who is it for?
Right. No, actually, clearly what Nehal said is absolutely right. I think, it's a legal provision, Sonia, that grants certain rights and protections to married women, basically regarding their property and assets. And I think one of the very key factors where it can be used effectively is basically, if you wish to ensure asset protection. You see, the Act provides protection to married women's assets from claims of their husbands, creditors. I think this is a very, very important line. So if you have a husband if you have a business which is a smaller MSME or you've got high leverage on your balance sheet, you've got a huge amount of debt, I think this is an act which will help you ensure that your property owned by a woman cannot be seized or sold to satisfy her husband's debt or liability. I think that's one of the foremost important conditions under which an MWP Act can be used, Sonia. The other very, very clearly is, it gives you great inheritance rights. I mean, the MWPA safeguards the women's rights to inherit property and ensures that women can inherit assets from their parents as well, relatives or other sources, without the risk of losing them upon marriage. So I think that's again something which is very, very important. I'm sure the male members are not very happy to hear this in your show, but it is a very important asset in a tool. And the other very, very quick one that Nehal did point out very clearly is on trust creation. It enables the married women to create trust and thereby protecting their assets. So broadly, it's basically a ring fencing tool available to married women, and you can do it through various insurance plans that are available, which can be sought from the market.
Okay, I have many more questions for you on the Married Women's Protection Act. So we'll do one thing. We'll slip into a quick break. We'll come back with lots more on the right insurance that you need to pick, the quantum of insurance, and of course, what all there is out there in the market. More on that coming up in a bit. Welcome back to Smart Money on CNBC-TV18. We've been talking about all the various insurance schemes in the market and what you need to pick, what you need to avoid, and how to plan your investment journey. Nasser Salim, Managing Partner at FlexiCapital, and Nehal Mota, co-founder of Finnovate, are with us. Before the break, we were talking about the Married Women Property Act and how it could be beneficial for you. Nehal, you were telling us about some of the advantages of the Married Women Property Act and who it is suitable for. Tell us a little more about that.
So, if I am a person who has a lot of loans, liabilities, like Nasser said initially, for me, I don't want my insurance proceeds to get attached to pay off my liabilities. So, Married Women's Property Act is good, where I take a policy on my name. I make my wife the trustee and my wife and children the beneficiaries. In any untoward event, the money only belongs to them. It will not be attached by any creditors or any liability or any kind of, risk which may be there, because of my decisions.
Okay.
So that is one thing. And in certain situations, like there are parents who have specially abled children and they cannot make decisions with their money. And parents are looking at a private trust, which is like forming a trust. The paperwork and all can get very expensive. They want a very simple solution that they just put in the money. They, attach an MWPA trust to it. The father takes the policy on his life. He pays the premium for 10-15 years. And after that, the child gets the money in the next 25-30 years.
Okay.
And through an MWPA trust, so the beneficiary is only the child. It can't go to anyone else. So for parents of a differently abled child, this is actually a very good solution to pass on the wealth and be assured that it will only go to the child and no one else.
Okay. So Nasser, just to wrap this up, right, the Married Women's Property Act, do you have to take an insurance policy under this act? I mean, what is the procedure in order to secure yourself under this act?
So it's very simple. You see, it's basically nothing but, there is no dedicated insurance policy. So yeah, what it does is, it's basically creation of a trust. You buy an insurance policy and then you name that into that trust, basically, and therefore it becomes under the MWP Act. So it's a very simple format. You basically create a trust, which is a simple documentation. Once the MWP is created, you ensure that the insurance policy, for example, that we're talking about today, you buy a plan, which would be a combination of, unit link plus savings, which would be an endowment plan, for example, from one of the most reputed insurance providers. You engage with your advisor, speak to him, and then he will basically buy that plan for you. And that plan then gets written in, which is basically as an application goes into it, which gets covered in the MWP Act as its policy holder.
Fair enough.
As simple. The moment that happens, it gets covered under the MWP Act.
Okay. Let's move on now and talk about the employer and employee plans, right, and what the merits of it are. Now, I'm asking you this question because a lot of us have corporate jobs, and with corporate jobs comes corporate insurance. But because we have that safety net of corporate insurance, many people don't take insurance separately. Then what happens in case you either lose your job or you take early retirement? Suddenly you're left with no insurance. What do you do at a time like this?
So the employer-employee could be a life insurance or it could be a health insurance. So if you're referring to an employer-employee where it's a health insurance from the company, then in that case, you should always opt for super top-up personal health insurance as well. In certain situations where you're, switching between the jobs, or like you said, the pandemic left a lot of people out of job, right? So you can opt for a super top-up plan with a deductible where whatever your company provides as the base sum assured, that is deductible, and over and above that, if there is an additional medical expense, then the super top-up plan kicks in and you're still covered at all points of time.
Even if you don't have the job?
In this case, a base policy, which is very small, plus a super top-up is handy.
Okay. And Nasser, you want to tell us these employer-employee plans? There are some different elements to this, and what are the merits of it?
Yeah, so Sonia, again, I think there are lots of merits to it. I think one of the most important things is that, it gives you, the employer-employee basically gets benefits to provide access to a comprehensive coverage, right, that may be affordable. So obviously, if you have more people being covered, the cost comes down drastically. So I think one is the biggest merit in this case is, Sonia, that because it's vast, it gives you comprehensive coverage to a large number of employees. The mortality risk or the per cover of insurance comes down. I think the other very quick one is shared premium costs. It basically, the employer sponsors typically involve cost sharing between the employer and the employee. So there's a cost sharing between both the employer and the employee in this case, and which makes premiums again far more affordable. So again, the same thing which I was saying in the beginning of the show. Convenience and ease of enrollment. I think the biggest advantage if I see, so Sonia, is it's basically very streamlined. So the entire enrollment process is very, very streamlined, making it easier for employees to select and enroll in the benefits they need. This saves employees the time and the effort of navigating the individual insurance market. So it's again a comprehensive cover. And I think as a group buying power, being part of a larger group plan, employees benefit from the collective purchasing power of the organization. I think that's again a very, very important point. And the last, I think financial security, Sonia, which also acts, as a great motivation for the employee. Employer-sponsored retirement plans such as 401k or pension plans, for example, offer employees opportunity to save for their future and receive contributions from their employer. So I think these plans also help employees build financial security and work towards their retirement goals, and therefore it acts as a big, big incentive for employees not to leave.
Okay, got that. So I just have a couple of more minutes left before we wrap up the show. So just wanted some final comments from both of you. Nehal, for someone who perhaps has no insurance at the moment, right? No term plan, no health insurance. What are the 2 or 3 things that one needs to keep in mind before selecting and making that decision?
So like I said, that a pure term policy is a must. Whatever is your age and your annual income, if you're in your 30s, at least 20 times of your annual income is a term insurance which you should must have. You check on the cover which your company gives you for health insurance, and a super top-up added to that will be beneficial. If you're young, you can look at an ADBR, accidental, benefit policy, because the chances in the younger age for mortality out of accident is much higher than any other illnesses, and critical illness cover, which is, a standalone policy where in case if you're diagnosed with any critical illness, the entire sum assured is paid even if you're not hospitalized. So it's not like a reimbursement. It is a claim being paid only on diagnosis of something.
So this accidental benefits and critical insurance is a part of the term plan, right?
You can get add-ons to a term plan where you can add a critical illness cover, you can add an accidental cover, or you can also opt for standalone critical illness or accidental covers, where in case if there is a critical illness, which really doesn't require hospitalization always, but it still keeps you out of work. Like for example, cancer, where you're getting treated at home, there's chemotherapy, and you had a critical illness cover, the entire sum assured is paid to you. So it protects you in case of loss of income while you're getting yourself treated. And it doesn't eat into the savings which you have already done. So for someone who doesn't have insurance, a pure term, a super top-up on his existing mediclaim from the employer, accidental rider, and a critical illness. These 3-4 things, if he does, I think he's mitigated a lot of risk for the family.
Okay, and Nasser, do you want to wrap this up? I mean, what are the 2 or 3 things that one needs to keep in mind before making that decision?
Good. 3 top things, Sonia. It's never too late. Please start now. It's always good to start early. There is something called a human life value, HLV, which I think Nehal was trying to allude to in the beginning of the show. It's called human life value. Please read up about it. It gives you basically your assessment, because insurance is not a tangible product. It's a service. So clearly, you should know what is the amount required and start early. Number two, I think, a lot of insurance plans, we've seen this happening, and, IRDA has typically come and said this, hiding this information. I mean, you can't hide information if you've got blood pressure, for example, in a disclaimer and just leave it blank. I mean, you have to mention, please ensure that there is something called a virtue of trust, and it's something between you and the employer, you and the insurance company. You have to divulge every little information about your health, about your current medical conditions, because if you don't do that, and if tomorrow, God forbid, if there's any claim, it will not be granted as per the IRDA ruling. Number three, as you start, you could be 25 or 30 years of age, Sonia. You possibly need only 50 lakhs of a term plan. Mid-30s, mid-40s, you have high liabilities. You've taken a mortgage. You've got children. You've got other responsibilities. You've got aging parents. You need to re-evaluate your life insurance plans and cover. So I think these top three things I would like to.
Okay, Nasser, Nehal, thank you so much for joining us on Smart Money. These are a lot of basics of insurance which people don't know about. I'm so glad we put some light on this topic. Thanks a lot for speaking to us.
Thank you so much, Sonia. Thanks, Nasser.
Okay, with that, it is a wrap on another edition of Smart Money. Thanks a lot for watching. Have a great weekend.